Hi, welcome to Stock Story. Today, in our stock picking analysis, I'm going to cover dividends. But before I get started, just a reminder, we're for education and entertainment. It's not financial advice. I'm not a financial professional. I'm just somebody who does this as a hobby passionately. Please do all your own due diligence, and if needed, get a financial advisor when making selections on your investments. Okay, so many companies' managements pay back some of the earnings to the shareholders, and that's what's called a dividend. And the amount of that dividend that they declare is a percentage of the actual stock price. So, for instance, if a company was to say the management said we're going to pay a dividend of $3 a share for the year over time, or if that's what they paid, then they'd be paying, if the price of the share was $100, then they'd be paying a 3% dividend. Obviously, if they paid $2, it'd be 2% dividend, or if it was $200, then it's all the ratio between the two. So the percentage of the actual dividend to the share price is the yield that it gives. You're going to see how growth of those dividends is so impressive in long-term gains when you do make an investment. The other thing is the portion of their earnings that they actually pay out as a dividend are there's a ratio on that. So, it could be half of the earnings, it could be a quarter of the earnings, it could be all of the earnings. Obviously, we want to look for stuff that has a safe dividend. Certainly, if they're paying more than what they're earning, that dividend can be in danger. So anyways, just as we did in the earlier ones, we need to have a company that's financially healthy, has revenue growth, consistent earnings, all the things that we had in the beginning. So if the 4 points I covered in the 4 videos on stock picking before this are not, if the 4 points aren't met, then it doesn't matter that they pay a dividend, because if fundamentally they're not sound, there's a chance that they could lose out on that dividend. So I'm just going to move my friggin' face out of the way there. Anyways, I just want to show you the power of dividend investing. These are some stocks that if you bought them in 1990, so 20 years up to May 2010, they've grown their dividends. So when you first bought them, it might have been 2-3% dividend, and that's why a lot of people don't get excited about dividends. But let's take a look. Over the years, every year they grew them, and some of them grew them at 20% annually, that sort of thing. So let's take a look 20 years later at what people are getting returned on their investment. And this is why, if you have a long time horizon, a dividend is really important. Look at McDonald's. In 20 years, every year there's a dividend check coming in for 52% of their original investment that they put in 1990. That's phenomenal. And when you think about it, 7 more years have gone by and McDonald's has continued to raise their dividend. A little bit less now because they're an aging company and their growth has slowed, but they still have been increasing it. So that 52% now is probably quite a bit higher. IBM, 32%. Walgreen, 29%. Canadian National Railway, 29%. These are the returns. These are fairly safe returns if those companies are always pretty solid. So you have to realize that a dividend can be a good friend on a good company. I still need the fundamentals, and actually I've been finding it more difficult to get good dividend stocks in this particular stock market environment because of the fact that people have bid prices up and they've been going after yield, so they've been going after dividend paying stocks, and because of that a lot of the dividends paying stocks are at higher their price is a little high to their actual fundamentals. So therefore, I'm not getting quite as many dividend stocks as I would normally like. Hopefully, if there's a big correction or that, I will dive into some big dividend names, and that would be great as far as my long-term income that comes in off my investments. Okay, there's three things I like to look at when I'm looking at dividends. I like to look at the yield. If you start too low, it's going to take a lot of dividend growth to get up to numbers like that 52% and that. If you start at 3 or 4% and it's growing 20%, you'll soon be over 10% return on your money from your dividends or from your initial cost pretty quickly. If you start at 1% or lower than 1%, it's going to have to grow for a heck of a long time, and that might be a little too much. So the big thing is I don't want to have too low of a dividend yield, and often a really low dividend yield means the price is pretty high, and I think you'll find a lot of times the fundamentals will be not up to par with what the actual stock price is. Whereas when you have a little bit higher dividend, that means that your fundamentals, your price of your stock is going to be a lot cheaper to your fundamentals. One thing though is if the dividend yield is extremely high, 7, 8, 9, 10%, you're now you have to really question why it's that high, because that means that the stock's been the price has been suppressed for quite a while, and so you want to find out exactly why that stock has been down that much. If you feel that it's just a mistake by the market, they're overreacting, then great, you've got this 7% dividend or 8% dividend, and you got the potential for it to grow if you really do have a solid company. So we want it to be safe, and we want to check to make sure the payout ratio is good. I like it when they're less than half. I like it even if the company has a slow year in earnings, that actually their dividend payout is so low and their balance sheet is so strong that their dividend is still safe and able to go. Also, it means that they can continue to grow their dividend even when there are down periods, because they have room. There's a lot of room. They still have lots of earnings left over after the dividend to reinvest into the company. So here's an example of a number of companies that look at, and let's just take a look at them. This is from back a few years, so these numbers are different now. But at this time, Apple had a revenue growth rate over 5 years annually. It was averaging 29%, which is very good. It had a dividend yield of 2%, not great, not bad. Had a payout ratio of 22%. 22% of their earnings. So there was a lot of room to grow it. Their balance sheet cash to debt didn't look spectacular here, but there's a lot of money offshore. So bottom line is, it looked like a pretty good, except for a low yield, it looked like a pretty good dividend stock. Plus, they've shown a commitment to growing it over the first few years that they've been issuing dividends. So it looks like a potential dividend growth stock that 20 years from now might be paying 20% return on your original investment on an annual basis. Bank of Nova Scotia here, at the time of this is around the time that I got into Bank of Nova Scotia. Now, their revenue growth rate's only 6%, but they do it fairly solidly. At the time, their stock was depressed, and so it was 5.2% dividend. It was less than half of their earnings, so that was pretty good, and they had 12 times cash to debt at that time. So that is why I bought in at that time. Now, they're still fairly valued, but I am watching them as their price has been going up quite a bit since this time. And this is the value of getting in when the price is low to fundamentals and has a high dividend. Now, as far as safety of dividend, Bank of Nova Scotia has been paying a dividend since the 1800s. So, and I think might be without fail. If they have failed, it might be 1 or 2 years, and they've probably grown it pretty much every year. So pretty solid dividend growth stock. So as you can look down, you can see a number of these ones have pretty good numbers. Here's Helmerich and Payne, and they're a oil and gas business that was hit hard by the oil downturn. And so you can see they have a 5% dividend. They've been growing their dividend annually for, I don't know, 40 years or something like that. They're one of those big dividend growth stocks. However, because their earnings have been hit, their payout ratio is now over their earnings. And that is, they have 1.7 cash to debt, so they still have some room, but it is important that they get back into making money as opposed to losing money. One of the things, though, this company was also having positive cash flows a number of years when they were showing negative earnings, which means that they could still cover their dividend. That has changed as the pressure of low oil prices has hit them even harder, right? So you can see down here, that's basically what we're looking at. Qualcomm was 60% of their earnings. That's starting to get a bit on the high side. So anyways, these are the things basically that I would look at. And if you have any questions, please put them in the comments section below, or any comments. Please subscribe to my channel. If you like this, please give it a thumbs up. Below, I'll have some links to the articles in Stock Story, as well as articles to Guru Focus, who I use for my fundamentals in this screen with these companies that down here on this screen are involving. So anyways, I hope you're having a great day. It's a beautiful day out in Vancouver, and we'll talk soon.